Welcome to the Chief Strategy Officer Podcast, a collaborative space for the architects of corporate success, the Chief Strategy Officers. In today's interconnected world, no single leader has all the answers. Here, we foster a platform for knowledge exchange where executives who lead strategy can share their unique experiences and tackle complex challenges, navigating disruptive technologies and driving impactful growth. The CSO role can be lonely and misunderstood, but what if there was a network dedicated to your success? Outthinker Network provides a supportive community of leading chief strategy officers offering time-saving solutions, trend insights, and invaluable peer connections. Visit outthinkernetwork.com to unlock the full potential of your role. In this episode, we're going to dive into a slice of M&A. If you're a strategy leader stepping into M&A or refining your inorganic growth strategy, there's one relationship that can either propel you forward or hold you back: your relationship with investment bankers. And in this episode, we dive deep into the often opaque world of investment banking with two strategy executives who have worked across both sides of the deal table. Together, our guests bring more than 40 years of combined experience across investment banking, M&A strategy, and corporate development, having led acquisitions and divestitures in both public and private companies across industries and borders. Michael Arlotto is the global head of corporate development and ventures at Kenvue, an American consumer health company, and the proprietor of many brands you've heard of like Band-Aid, Benadryl, Neutrogena, and Tylenol. You may know them as formerly Johnson & Johnson Consumer Products. Chris Nuttall is the Executive Vice President of Corporate Development at Bizarre Voice, an American tech company that helps brands collect and leverage UGC, which stands for User-Generated Content. He also brings a long history of leading transformative acquisitions and divestitures across multiple industries. Together, the three of us explore how to assess and build the right relationship with an investment banker, what transformative M&A really means and how to pull it off, the soft skills and cultural fit that matter just as much as deal terms, how to avoid M&A regret by starting with strategy and ending with integration, why successful M&A is less about buying a company and more about buying into a multi-year business plan. Whether you're planning your first acquisition or fine-tuning your approach to external growth, this episode will help you build stronger partnerships, avoid costly mistakes, and execute deals that deliver long-term value. Michael, Chris, thank you so much for being here. I've already given a little bit of background on your experience, but could you just give us a little bit of how did you get into this role? Because you're in a chief strategy officer role, or a role that includes strategy, and managing, working with bankers is a big part of it. So M&A is a big part of it. Let's start with you, Michael. How did you get here?
Yeah, so I oversee our inorganic strategy, and thank you for the introduction. I oversee our inorganic strategy, including leading all M&A activities, early stage investments, partnerships across all regions and segments. Also lead our long-term strategy work as well. And prior to that, I was in other M&A strategy roles across consumer and B2B businesses, and before that, investment banking. So I've been both on the client side and then on the in-house advisory side. And so I've seen both sides. I've also bought companies and have been acquired. So I've also lived on both sides of it as well. So that's how I first got into it.
So you can speak to us both, from both sides. That'll be really, really helpful. And Chris, how did you get to, the role that you have now and the work that you do within M&A?
Career started off in management consulting, working for strategic advisory consulting companies, primarily looking at the intersection between M&A and transformation and strategy. So I did that for many years. And then about 10 years ago, went onto the client side in a corporate development leadership role to drive M&A partnership strategies for public companies and now private companies under private equity ownership. So my background is really 20 plus years of M&A experience covering private equity, public companies, both in the United States and globally. For me, M&A is really an enabler for driving business transformation at a faster rate and speed than you could otherwise achieve on a purely organic basis alone.
Now, I'm glad you brought that up because I want to, before we go into the questions, I think people who are listening have a certain idea of what use case we're talking about, what situation we're talking about. We're talking about someone who wants to acquire someone. They haven't identified who that is, and they hire a banker to run a process, to do a search. But that is not the only scenario, right? So just to open our minds a little bit, Michael, could you just describe some other scenarios?
Yeah. Also on the divestiture side or sell side for founders of businesses, for entrepreneurs, when business gets to a certain size, they'll engage bankers to then sell themselves to either find growth capital to take them to the next level or to sell 100% of their equity to a buyer. So it can be anywhere from 100% acquisition to 100% sale, and then various equity raises and transaction structures in between.
Got it. Great. And then, Chris, you talk about transformative M&A, right? And we've talked a little bit about that before. Can you tell us what that is? Because you have worked on transactions that have transformed companies, but also industries. What's the difference between transformative M&A versus what a listener might be thinking about?
I think first and foremost with M&A, you need to think of it as an execution strategy for how to accelerate your strategy. So you start with a strategy. As part of that, there's typically a build by partner assessment around what's the best way to achieve the strategy. And then under certain circumstances, it's just not possible to achieve the strategy through building the solution yourself. And in that scenario, you then open up ideas around, is it going to be better to achieve the strategy through partnership or through acquisition? If it's through acquisition, that's when typically a banker would get involved. The banker is, think of them as a market facilitator or market maker in the market for control. And so it's around a buy or sell transaction, whether the banker is incentivized to either help you buy a company or help you sell a company. The bank only gets rewarded typically when the transaction gets closed or completed.
Great. So, Michael, look, I think you agree in our prior conversations, strategy first, build, buy, partner, then the M&A strategy is meant as a tool to execute on the strategy. And now you're at the stage where you're deciding who you're going to work with. Can you just walk us through your process for assessing?
Yeah. So I think what's really important in this process is building strong relationships. And so as you're evaluating investment bankers are happy to meet with you. They're happy to share their insights. Bankers trade on information, so they will let you know who they've met with and note that they will, tell others that they met with you as well. So you also want to manage the information flow that you're sharing with them as well. But building strong relationships and building trust so you can share more information is key. And so the way to build that trust is really understanding their credentials, their expertise in the space, if there's specific targets that you're focused on, understanding if they have any, particular insights into those businesses that are different from others, and that you're able to really leverage their expertise. I'll say another piece that's important is just kind of the cultural fit too. Mm-hmm. And as you meet with different bankers, there's different cultures of the different banks, and then also within the individual bankers can be very different. So it's also, you want to get someone that you're comfortable with, that you trust, and that you can really build a relationship with. But first and foremost, it's really going to be the strategic expertise of that individual banker will be the first filter you look through.
No, I'm glad you mentioned the cultural fit, because that was going to be my next follow-up question, was beyond the kind of the relationships and experience, what are some of the soft factors that also come into play? And so cultural fit, is there anything else that influences your decision?
Yeah, I would say, the reputation is also really key. You want someone with a strong reputation. They're going to be potentially out in the market representing you and your firm, your company. And so to make sure that you're comfortable with how they are representing you and the guidance you've given them, how are they to deal with? If they're rude to other people, not responsive, that's not who I want representing me or my company. Yeah. And so understanding that piece is, really important as well.
Great. Anything you would add, Chris?
Yeah, I think often the banker plays a role in helping to build financial models associated with the business, whether that's buy-side models or sell-side models. And so I think getting access to a team of experts that actually understand the business and the industry in which they're working is critical. Because if you're a buyer and you're looking at a sell-side financial model, you want to be clear what you're looking at and understand the nature of the business you're looking to buy. And equally, if you're on the sell side, you want the model to represent barely what it is you're selling. And so there's often a key role that the banker plays in that process in helping to, put together some of the artifacts that are needed in order to facilitate the market and the transaction.
Yeah, it's interesting. Yeah, and because you're also talking about like long-term relationships. This isn't just one transaction. This is going to be, as you say, it's also your reputation and the interactions that you have with everyone in the market. It's an important decision. But who else internally do you coordinate with? You got your CFO, you got your CEO, you got your board, maybe your COO. How do you think, Michael, about how you engage with them? Like, when do you engage with them, and what role do they play relative to the role that you and the banker play?
Yeah, so you would want kind of upfront aligning on the overall strategy. So back to the big picture strategy of where you're trying to go. And then on the inorganic piece, aligning on those potential targets too. So generally at an early stage, we'll keep on an informed basis the board on where we might be looking, where we're thinking, the types of businesses that we want to potentially add on to. And you're developing that target list with the business unit leads as well. So they're owning their markets, they're looking globally at how they want to grow. And helping refining that target list. My role is to help to further refine that target list to really get down to operationally which one is a much better fit for us, what is available, do we think we could get at a fair price, and then to begin an outreach to the company and to learn more and to try to develop a relationship upfront, which an investment banker can help make happen as well.
I think if I could add, having established your strategy, your build by partner strategy, and your areas that you want to buy into, it's really important to create some kind of market landscape view of the players in the field so that you understand who are the key participants and potential targets. And there's often dozens or hundreds or even, in some cases, even thousands of potential targets. And so there's a prioritization exercise that needs to take place, which is what are the targets that are most likely to be of interest from the company perspective. And I think the banker plays a key role in helping, to Michael's point, to supply information to help feed that prioritization framework. So, when you're looking at a landscape, with hundreds or thousands of companies on it, how do you know which ones are the right ones to go and buy? Well, often the banker has inside information on many of those, and you can use that information to help improve your own prioritization strategy for which targets to go after if you're looking at an outbound strategy.
So how do you know that the banker is doing a good job and doing the right thing? I'm thinking, do they understand your strategy? Are they assertively, filtering through those hundreds of thousands? Are they using the right sequence of filters? How do you feel confident that they are doing a good job, especially since, as you said, their motivation is for a deal and they get paid mostly on the back end of that deal? How do you know, Chris?
I think it's up to you to actually help explain to them what your strategy is and what type of targets you want to look for if you're on the buy side. So I think there's a responsibility to engage with the investment banking community in a symbiotic way to actually help them understand what it is you're looking for so that they can filter out on your behalf and bring opportunities to the table, either opportunities that exist or in some cases opportunities that may not yet exist but could be interesting companies perhaps you've never heard of. So there's a lot of ways to build a market map, but I think the banker is a key resource to help you do that. And they also, sometimes some of the bankers have their own market maps as well, which you can leverage.
Yeah, that's where really having a trusted advisor is important, because the more you can share, the more you're comfortable with sharing with that banker and giving them more insight on what's important to you and what's not and how you're thinking about it will help that banker fine tune and focus on the opportunities. Being a little bit more removed, a little bit more vague, they come back with something much broader and all over the place. It's not a fit. So that's where finding that balance of the more you can trust the party you're working with, the more you can share, the better advice you're going to get back from them.
Yeah, I don't have a lot of experience, but I remember being in a meeting with a client and they were working with a banker, potentially going public. And they had been talking to this banker now for months, and they were kind of settling on this one rather than the other one. And at this meeting, the banker said something that was so clear that he did not understand what business they were actually in. And it was like the whole conversation screeched to a halt.
Banker is not in the business, so
Right.
it's not probably reasonable to expect every banker to understand all the nuances of a business. But you certainly want them to understand the overall business model, the industry dynamics, the relative merits of the key players in the industry. I think many investment banking teams specialize in certain verticals and sub-verticals, geographies. And I think that's all very helpful because it means the expertise is much stronger than it would otherwise be if you just sort of worked with a more generic banker that wasn't specialized. So I think that specialism is a key thing to look for if you're looking to work with a banker in any form.
I guess it also has to do with how specialized your business or how unique your business model is. Got it. Let's talk about the other players around the banker. Michael, you're outside counsel. Maybe you have consultants there. How do you think about the composition of that team? And when do you start looking for those people? Is that later on in the process?
Yeah, those are, all important advisors and part of the team. It's probably different between the timing in terms of buy side and sell side if you're looking to buy something or you're looking to sell something. On the buy side, you may have consultants early on to help you look at the space broadly in that market map development, or to evaluate maybe some companies that are in that space that you're interested in, and to do some research there on the space more broadly is generally where we brought in some consultants on there. As you get into a transaction, so your banker is advising you, helping you on the valuation, providing introductions, leading potentially negotiations, but you have your accountants evaluating the information that is provided from the seller. So you have your accountants working on there. You have your legal team reviewing the legal documents and drafting the purchase agreement as well, and looking for any other legal liabilities as well. You have your tax, looking from a structuring standpoint, looking at the tax profile of the business and looking at a pro forma impact of acquiring this business, how that could impact taxes as well. So all key partners that are involved early in the process. I would say, for us, often a lot of processes will follow a two-step process where you submit a non-binding letter of intent, and then later you move to a binding offer. And as you go through these rounds, you get access to more information. So a lot of the work will start kind of post the acceptance of a non-binding LOI. At that point, a data room is opened and you have a lot of information that the company is now sharing with you. Your offer is compelling to them and they want you to do more work and to move to a binding offer. And that's really where you start to gear up the advisors and spend money. Prior to that, not typically, just evaluating it within the in-house teams, legal team, some finance, strategy, M&A, reviewing it. But it's non-binding. We can walk at any time. But then we start spending money with advisors when we go to that next phase.
I would say typically the role of the banker is the process owner or the project manager. So typically there will be a owner of that process from the sell side perspective, because often there's multiple buyers involved when somebody's selling a business. And so the key role of the banker in that sense is to orchestrate the process, manage the project, get the virtual data room, and manage the interactions between the typically multiple buyers and the seller.
And those other advisors, you can just sort of plug them in and unplug them. They work easily together, or are there certain law firms that work better with these bankers and accountants, or there's like a constellation of, a team that work well together?
We're a large firm, so we work with different law firms for different categories of needs. And so, if it's a competitive issue, we might use one law firm. If it's just a general business review for M&A, we use a different law firm. Based on the scope of work, we'll assign work. We also have our auditors who then we have to use a separate accounting firm for reviews of this types of information. So that creates a little separation in terms of the types of companies and who we can use for. But in general, there's a lot of providers that can do, accounting and tax due diligence and tax structuring, based on the size of the deal, may dictate the type of firm you want to go to. If it's a small deal, you may be able to go to like a boutique or an individual that can help you with that, or do some of it just in-house, which, we will do some things in-house as well. But there's a lot of providers in the space that can offer these services. And generally, they're organized by industry, so they understand the nuance of the industry. And typically, we'll be providing like a quality of earnings report to review the historical financials, and then we'll take a little bit of a look at the projections as well, just to make sure there's nothing funky going on from an accounting perspective.
The key here in my mind is, whether you're buying or selling, there should be a transaction leader who acts as the sort of single integration point, if you will, for all of the different people involved. And then, a key part of that person's role is to ensure that all the consultants, advisors, and bankers involved have clearly defined roles so that there's no gaps or overlaps between the roles of the different consultants, advisors, and bankers.
And so that would be the lead, who's usually the project manager that manages those potential overlaps?
Normally, the buyer or the seller will have a transaction leader who is part of the company.
Oh, gotcha.
And it's that person's role, whose role is to ensure that all of the consultants, advisors, and bankers have clearly defined roles.
We have so much that we want to cover, and reaching towards the top of our time with you. Let's talk a little bit about fee structures and fee levels. What do you need to get right when setting that? How are they negotiated? Chris?
There's different types of fee structures available here. Often bankers are engaged on a retainer basis, and sometimes they have success fees, sometimes both. It really depends on the size of the transaction, the complexity of the deal, the geography, the level of involvement needed. But there's typically a set of discussions with the bankers around, what does success look like, and what is the right way to incentivize that success, either through some combination of retainer or success fee, which could be typically a percentage of the transaction value.
And we've been speaking about investment banks. Within that, there's a lot. There's the bulge bracket that are, serving multinational companies. There's middle market, there's boutique, there's M&A advisory firms, there's brokers out there. So within that, there's a lot of different levels of services and capabilities and cost structures that they're carrying that they need to support by doing the deals too. So as you get in, you'll find the right partner for you based on the size of your organization, and the size of the deal will help drive on who's the best partner for you, and will give the best service and advice as well.
So I could see someone who's, say, newly doing this, they can make the assessment of whether the deal structure works for them, given their internal ROI calculation. But there's also the check on the market. How would you just check that the structure that you're aligning on is market?
We'll, do our own valuation, kind of traditional metrics of, discounted cash flow, trading multiples, transaction multiples, to have a sense of the value. And then getting the banker's perspective is obviously very helpful. And there's also sometimes just expectations, and expectations can, be out of whack. I've heard this anecdote that if you ask a banking analyst, how you value a company, they'll tell you just that, DCF, multiples. But if you ask a senior banker, how you value a company, it would be, what is a buyer willing to pay? We try to put more science behind it, but it is an art, and it's based on a negotiation and market conditions. What are two parties willing to agree to? And so you try to hold on to your value, and that you can make the deal work, looking at the returns, the strategic merit of the transaction. What does it mean if you don't get the transaction? Are there other targets in the space that you could go after, to help drive, how much you're willing to pay? And that danger of overpaying is the slippery slope, the deal fever of not wanting to lose your competitor outbidding you. It creates an inertia in an organization. And so to try to hold on to your principles of how you came up with that value, will be key. You want to be prudent, stretch when you can, but when you can't, being willing to walk away from a deal.
I think every company, whether it's buying or selling, has, unique features about it, which make price discovery more difficult. You can, of course, look at comps in the market. So what are other companies doing, trading comps or transaction comps? But often those comps are pretty subjective. And so it's even more difficult in the case of private companies versus public companies, where often those comps are just not transparent.
Yeah.
So price discovery is a key issue, and bankers play a key role in helping to facilitate both the discovery of the price, but also align the buyer and the seller to a price that both are willing to accept.
Right? Did you buy the right company? Did you pay the right price? Was there a good cultural fit? Was there a good strategic fit? And working with the banker seems there's a lot of potholes that could result in years later it not being successful. What are the 2 or 3 key things to think about up front to avoid that turbulence and maximize the chance that 3 years after the acquisition, you feel good that this was the right thing?
I would say starting with the strategy. The business is on strategy up front and getting that alignment internally before kicking it off. I think that forces a lot of questions on the organization and whether this is the right space and then whether this is the right asset. So that strategic alignment up front is, I would say, the first key. The second key is running a good process. The due diligence is to confirm your investment thesis. It's to identify issues that you may not see from the outside. And it's also to plan for integration. A lot of those issues, you can deal with either from a price perspective or it's just something you can mitigate on the back end once you own it. And so to really use that to inform your integration strategy, whether it's going to be a standalone business or you're going to fully integrate it or somewhere in between or pacing, you align on that strategy as well before you sign and close so that everyone is on the same page. And when you move forward, you have your marching orders. That helps mitigate that risk overall that either you miss it strategically, you miss something in due diligence, or you did a poor integration. Managing those 3 pieces will mitigate a lot of that M&A risk down the road.
Great. Yeah, I love the framing of due diligence with that intention in mind. Chris, anything you would add?
I totally agree with Michael on the strategy and transaction and integration side. I think the best way to think about M&A is not as a transaction, but as a multi-year business plan. And what you're doing during an M&A process is you're not just doing a deal, but you're also looking at the whole business plan for the next 3 to 5 years. And so in many regards, an M&A done well is actually an organizational change, not just a transaction. And that puts you into some direct tension with the banker, of course, who sees it as a transaction, not as an organizational change. Mm-hmm. And so I think it's important for the CSO to think of this, as Michael indicated, more strategically as a multi-year process. You're not just buying the house, you're also buying all the maintenance contracts associated with the house. I think it's important that long-term perspective is thought about before you do the deal, as opposed to thinking about it afterwards. The banker is often not incentivized to think about what happens after the deal. The day the deal closes, typically the banker walks off with a large check. So they're not necessarily incentivized to think about what happens 3 months, 1 year, 2 years, 3 years later.
Yeah, got it. I know we only scratched the surface of your knowledge and experience here, but I want to thank you, Michael and Chris, for taking the time to unpack for us some of this. Really, there's so much more to learn, but I think that people who listen to this, they can take some of your advice here and it could save hundreds of millions of dollars of pain for a lot of people. So thank you so much for being here.
Thank you.
Thanks, Kyan. Yeah, thank you.
Thank you for listening to the Chief Strategy Officer podcast. If this conversation helped you think differently about strategy, M&A, or the role of investment bankers, share it with a colleague or leave us a review. Until next time.